What is up, guys? Welcome back to another episode from Coin and Capital. It's Chris, and on this channel, we talk about finance, macro, crypto. We look at charts, we break it down, and try and find some truth in all of this noise together. All right, you already know today's episode, the Fed is in the hot seat yet again. We're going to talk a little bit about some recent comments made by some pretty high profile people in the finance world, one of them from the Fed itself. Then we're going to look at Bitcoin, what's been going on in the markets this week. We're going to tie it into some macro backdrop, right? Because if we understand the macro, we can understand Bitcoin and where it's headed a little bit better. And then finally, we're going to take a look at stable coins, okay? There's been some exciting stuff happening in the scene, and we're going to talk about it today, okay? So strap in, the charts are coming. Let's get right into it. Off the rip, fiscal intrusion into monetary policy is the topic we're starting off with today. Why is that, ladies and gentlemen? Well, because the Donald Trump administration, of all people, we've known this, right? We've talked a little bit about it on the channel, but they are notorious for sticking their nose into the business of the Federal Reserve, right? And we know, hopefully you know, if not, the Federal Reserve is, in fact, a private organization, right? Whether that's a good thing or not, that's to be discussed. However, the way things have been running for the last 100 years, the state has had no say in monetary policy. It's decided behind closed doors with a group of 12 people, and we just kind of had to live with it, okay? Trump administration, though, they're not having it, right? They want specific things to happen, mainly rates to come down. They've been very adamant about saying this, and they're not shy about particularly doing things, making comments, making actions towards the Fed, right? They're not very scared of repercussions here, because now we have people like Citadel's Ken Griffin, massive hedge fund guy, urges White House to distance itself from the Fed. Okay, so big guys like Ken Griffin on Wall Street are saying this. You know the administration has been doing something little little out of the normal, okay? But why is this? Well, beside the article here, we have the Fed balance sheet, right? And we know from last video we posted on this channel, the Fed has begun some form of QE, but they're not calling it QE, they're calling it technical buybacks. They're using the balance sheet, okay? They're using the balance sheet after QT has been going on for too long. Okay. Now, whether this is because of the pokes and the jabs the Trump administration has been throwing, we don't know, but we do know that the balance sheet has started to expand again, which for us is positive. Not the only comments being made from high-profile people on Wall Street lately, okay? Fed's Waller says that rates are still 50 to 100 basis points above neutral, above where they should be. Okay, this guy works at the Fed, and he's saying rates are still too high. The Trump administration are saying rates are still too high. They've been bullying Powell nonstop because rates are too high. Okay, behind that, we have the Fed funds futures. Okay, really quick, when this thing trades up, it means people are pricing in more and more rate cuts. Okay, when this thing trades down, people are pricing tightening, rates getting jacked up. Okay, so far, this has been on a rip. Okay, pair that on top of Mr. Waller saying 50 to 100 basis points above neutral. Okay, starting to get a picture. Pair that with Trump administration poking their nose into business they have no business being in. Okay, rates will, in fact, be coming down in the near future. Okay, It has to, right? In order for all of this $37 trillion of debt to be financed properly, you can't be doing that with 4% rates, let alone 3, maybe 2, 1 to 0 is preferred. Okay, we'll see what we get later on. And what the hell has been going on with Bitcoin the last week? Well, guys, we've had a month of sideways, okay? After a month of 30% down. What the hell is going on, right? We thought we know rates are getting cut. Isn't that bullish? Liquidity is coming. Isn't that bullish? Yes, and yes, you are not wrong there, guys. But what we also need to understand is that Bitcoin is now tied to the whims and wills of the ETFs. Okay, and who controls the ETFs? Well, for the most part, it's BlackRock and dudes on Wall Street. Now, it's not exclusively tied to it. However, ETFs do have a bigger impact on price than before. What we can see from the swap Bitcoin ETF flows, it's not been looking good the last month, right? We've also talked about this on the channel before, but these institutions run basis trades through these ETFs, so they profit from the spread. And when price tends to collapse, right, say from money market stress or the TGA being refilled, right, when liquidity gets sucked out of the system, that basis compresses and that trade no longer looks good and is no longer as profitable. So then institutions say, see you later, and sell off a good chunk of their Bitcoin, right? Which checks out, right? 30% drawdown is not good for basis. However, they're buying again, ladies and gentlemen. You see that last tick, okay? They have been buying again through this chop, right? When the market moves sideways, it means supply is being distributed to new hands. Now, in relation to Waller saying the rates are 50 to 100 basis points above neutral, this implies that conditions are going to ease quite a lot in the future, next 3 to 6 months. Also meaning liquidity will become way more abundant in the next 3 to 6 months. Okay? How, or more specifically why that is, we can reference the top left white chart here, which shows issuance along the curve, the duration curve, okay, from the US. What we can see here is that the blue line has taken precedent over the red. So the blue is T-bills, the red is bonds, okay. The red is duration, so think 5, 10, 20, 30. The T-bills are 3 months. Okay, very short end duration. Okay, why is that important? 1, the US needs to roll $8 trillion of debt. Okay, they can't do this when rates are 4%. Okay, and now a good chunk of that debt is being refinanced in the short end. Okay, in these T-bills, which is why we're seeing that blue line diverge away from bonds. Okay, why is that? The US is having a really hard time finding people who want to buy duration. Okay, basically nobody right now wants a 10-year promise from the US government to be paid back in fiat, right? So if we think the debasement rate is 8%, so currency is being devalued 8% a year, you get a 10-year promise to be paid back. It's like saying 10 years you're going to be paid back 80% less. Okay? But who is buying all this short duration? Well, below that white chart, we again have the stable coin supply. right? With USDT remaining dominant. Now, due to some legislation being passed, stablecoins are now needed to be backed one-to-one with cash or treasuries, right? Short duration debt instruments, okay? So the US has found a buyer that is willing to take this short end issuance, okay? Meaning all these stablecoin companies in the US have to take this short end duration, right? Which in turn puts downward pressure on the short end yield, okay? But this also provides the crypto space with ample liquidity, right? Because as this issuance ramps up into 2026, as the Fed prints more money to accommodate for this issuance, stablecoins are going to soak up a big chunk of it. Meanwhile, that newly printed money is going to soak up a bunch of it too, right? Sticking on the Fed's balance sheet. But when these stablecoins soak it up, this in turn grows the whole crypto space, right? And then Bitcoin absorbs a good chunk of that liquidity too, right? So in order to grow stablecoins, Bitcoin will simultaneously grow alongside of it. And then to finish off this little segment on stablecoins, I want to show you the total assets managed by money market funds. This is the main place where T-bills, bonds, all that kind of new issuance and whatnot gets soaked up and ends up in money market funds, okay? And we can see it's creeping up $8 trillion, okay? So $8 trillion of these debt instruments have been soaked up into money market funds where they earn some passive yield, okay? Now, the thing about stablecoins is that stablecoins have been pushing to be able to provide yield, right? They do this by buying these short duration T-bills and transferring that yield to the consumer, okay? Now, the thing about stablecoins is that they bring that yield directly to the consumer's wallet, okay? So in turn, they're competing with money market funds, okay? Now, consumers don't get access to this fund, right? They don't get access to the yield money markets generate. However, coming in the future, consumers will be able to access the yield generated from stablecoins. Now, keep in mind, each of these, right, the money market funds and stablecoins rely on debt instruments, whether it's T-bills or bonds, okay? So stablecoins are directly competing now with money market funds. And they will win, right? Why? Because stablecoins are giving yield directly to the consumer in a very easily accessible and utilitarian way. Okay? Now, money market funds have $8 trillion earning passive yield, okay? In order to become competitive, again, with stable coins, we could potentially see a lot of that $8 trillion begin to get tokenized, begin to come on chain, right? That's a lot of capital coming on chain. $8 trillion locked up in money market funds, okay? Right now, stable coins are 300 billion, 8 trillion in money market funds, right? In order to be competitive, this capital needs to come on chain. Remember what I said, when stable coins grow, Bitcoin grows as a byproduct, right? $8 trillion coming on chain. Issuance moving to the short end of the curve, right? Preferred T-bills over bonds. T-bills over duration because the stable coins soak it up like no tomorrow. Rates 50 to 100 basis points above where they should be. So guys, this is painting a very, very clear picture to me on what 2026 could look like. Okay. Yes, it's probabilistic. Yes, there may be some black swan events, but the probabilities are lining up for a very, very bullish 2026. So moving forward, what can we expect? Well, here I think I'm going to use the S&P chart, this chart of the S&P, to kind of contextualize things a little bit, okay? Now, the S&P, as we know, mirrors M2 quite well. It's a great gauge for liquidity in the system. It used to be a very great gauge on investor psychology. However, now it's being kind of warped from this money printing. But we can still kind of derive a little bit of signal here. Especially, I think this weekly candle that we're printing right now says a lot. Okay. And what this is telling me is perhaps there was some investor shock, or in fact liquidity shock in the market this week. Perhaps some turbulence, mostly I would say psychologically, right? Because we've seen the plumbing is sound now and liquidity is being pushed through it. However, now liquidity is beginning to override psychological disconnect, okay? Because this candle, this weekly candle, we've seen price try to push down, okay? Perhaps some news wasn't taken well. Perhaps some investors are pricing in more risk, right? Looking at the forward curve, okay? Looking at the duration end of the curve, right? If you see the 10-year, the 20-year, the 30-year, it's not looking pretty, okay? Maybe there's something going on like that. However, liquidity has begun to override that. All right. So no matter how bearish or risk adverse people are becoming, liquidity is saying we're going up regardless. Does that make sense? Right. We see it now in Fed speak. We see it in the issuance trend, choosing short dated over duration. We're seeing that in the stablecoin market cap growing. Okay. Guys, the signs are all around us that 2026 is going to be a great year. We just have to pay attention, stay patient, and perhaps not check our wallets every 30 minutes. Okay. Broaden your time horizon. Okay. Curate quality information flow. Perhaps even try and distill some of your own opinions, okay? Perhaps some of the stuff I say on here people don't agree with, right? But these are my opinions that I've concluded from looking at charts and data, okay? And that's all we can do to prepare ourselves for what's to come. So, if you guys enjoyed the video, drop a like, comment, subscribe, all of that good stuff. And as always, catch you guys in the next one.